Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. The issues we are facing are significant. Inflation is at its highest level in decades. Central banks are working to unwind more than a decade of extraordinary monetary support to fight inflation. Europe's two largest countries are at war. We have a lot that we need to work through in the marketplace. Joining me to discuss is Quincy Krosby. She's the chief global strategist with LPL Financial to discuss how to effectively navigate these times successfully for the second half of 2022. Quincy, it's great to have you with us. Welcome to Trade Talks.
Thank you, Jill. Appreciate it.
Let's start with the economy following the second quarter GDP print, which shows two negative quarters in a row. While jobs and the consumer remain relatively strong, is there enough momentum in the economy to not fall into a full-fledged recession?
That's the biggest question right now, and whether or not this is actually a harbinger, just like inverted yield curve, moving to a deeper recession. It depends on the Fed, Jill. It depends on whether or not, if they find they have to go even more hawkish, longer, the job market is going to weaken. It will not go to 4.1%. It'll climb higher. This is what the market is focused on as to where the Fed is headed. And clearly, the numbers you're talking about, today's report, the PCE, the employment cost index showing that prices remain higher. Inflation is intact.
Do you expect inflation to cool in the second half?
Yeah, absolutely. The Fed is already slowing down momentum, slowing down demand, and then we think in the second half it will then meet the supply chain challenges easing. They're already starting to ease. Containers are showing up. They're moving. Yes, we may have a strike out in California at the ports, but nonetheless, we're seeing the supply chains beginning to unwind. We're seeing inventories showing up. Again, just look at the containers. You see pictures online. This is what we want to see, prices coming down. Unfortunately, at the same time, we're going to see consumer demand pulling back. But nonetheless, the Fed is going to wipe out inflation. They have to. They can't allow stagflation to remain. As far as portfolio managers are concerned, I think every survey indicates they'd rather have a recession, get rid of the inflation, rather than have the Fed stop and leave us with a stagflationary environment. That's uncertainty at its peak. In fact, stagflation is.
Yeah, thank you for making that distinction. And stocks are facing strong headwinds and largely depend on the pace at which inflation falls. What's your outlook for the second half?
Well, the second half, we think that we're going to gain momentum in the equity market. August and September tend to be very dicey. You usually have a move right by the election. Historically, now granted, not every data release has a Fed fighting inflation, but nonetheless, what we expect is that the market will gain the first 3 months after the election is finished, and we could actually see a positive momentum. The Fed is going to be finishing its job. Even if they have to go to 1%, 100 basis points, they're going to do it. They have the luxury right now of a still solid labor market. That's why we think they want to move more aggressively now, front loading it rather than space it out over a long period of time.
Finally, bonds got off to a historically bad start for the year. Are they starting to show any value now?
Well, they are. It depends on your forecast of what you can expect over a year, or if you're a long-term investor. We do think that the market is not finished with the bear, that the process has begun. We've seen it, but we need to see more of a catalyst to get the bear eradicated. Not every bear market leads to a recession, by the way. If a recession does hit, it means a little bit more weighs down for the market. But what we're seeing during this earnings season, Jill, is companies able to navigate all of these headwinds. Stronger dollar hitting our biggest exporters in technology, yet they're managing to give that bottom line and maintain margins, right? And have the bottom line intact. We're seeing that the middle to high-end consumer, we're seeing that via Apple, we saw it through Amazon, still spending, still actually confident enough to go out and spend. Both of those names, Apple and Amazon, attract a middle to higher end wage earner. It's showing up in the numbers, and the numbers don't lie. The guidance also is positive, and that's what this market needs going to finish the earnings season, is to have a glimmer of hope, and that's going to keep this market, I think, relatively intact, despite what the pessimists are saying. This earnings season has come out, the estimates have been holding up and even surpassing the estimates. It's a major surprise. We're already into the earnings season. This week is big tech, and basically, except for one, they have not disappointed.
All right. Quincy, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Market Reporter at Nasdaq.
Thank you.
Oops.